Hello, everyone. Today I'm joined by Darcy Frisch, Managing Director of Hearst Ventures. Where are you dialing in from today, Darcy?
Hey, Julian. I'm in New York City.
Awesome. How are you doing today?
I'm good. It's the day after the election, and we've got our head down. We're back to work.
Exactly. I'm super excited for this podcast. I've known you for about a year, and I think this will be a really interesting episode to sort of hear your perspective, given you've been in the venture space and invested in a lot of different areas. So I think this will make for a great episode. But before we dive into the actual details, I would love to just get a general overview for our audience of what is Hearst Ventures, when was the fund created, and sort of like what are your specific sort of areas in investment, both from a sector perspective and also from a stage perspective?
Yeah, great. I usually kick off the introduction of Hearst Ventures with a little introduction of Hearst, because Hearst Ventures is Hearst Corporate VC. We invest in early stage tech businesses. We're not a fund. We invest off of Hearst's balance sheet. Hearst is a privately held diversified information and media company. Our investment areas at Hearst Ventures line up with the industries that the corporation operates in, and those are consumer, transportation, healthcare, and financial services. Hearst Ventures dates back to 1995. Our claim to fame is that the corporation's first investment was in Netscape, the web browser.
And could you maybe describe sort of what drew you to the venture space and a little bit more about your background in terms of where you started right after undergrad and then how you eventually found yourself working for the venture capital arm of Hearst?
Yeah, sure. I mean, after undergrad, actually, it's appropriate on the day after Election Day. I was a poli-sci major, and I desperately wanted to work in policy in Washington, D.C. I ultimately did with a senator, did that for a couple of years, did some consulting for KPMG for a couple of years, and then realized that I didn't want to be an accountant or a tax lawyer. So I went back to business school. And after earning my MBA, I took the road less traveled, didn't go banking or consulting, and joined a successful DC-based entrepreneur who had decided to launch his own startup incubator. I had previously been in a finance role at one of his companies and jumped at the incubator opportunity, mostly because it moved me from DC back up here to New York City, which is where I've been for most of my life and career. But I helped him set up shop for 4 early stage companies that he had seeded. Actually, this is an interesting and circuitous story, but my path into venture was exactly that, circuitous. I took one of the companies he had seeded. It was called Blue Mercury, and they were making a run at selling premium cosmetics and skincare online, going back all the way to the late 90s, like 99. And the founder was looking for venture capital, so we brought her around to Hearst, who A, had a venture capital group, and B, had all these fantastic magazines that were used to female audiences, et cetera. So we visited Hearst Ventures. Hearst didn't invest in Blue Mercury. And fast forward a couple quarters, the incubator that I was working for, the entrepreneur decided to wind it down. So I found myself looking for a new opportunity. I went straight back to Hearst and said, you guys know all the entrepreneurs and all the venture capitalists in New York City, and I'd like to work with startups. Please keep me in mind. They had an opening on the team. I took it, and that worked out. So it was more opportunistic than really a planned path. And I'll add as a sidebar, it also worked out for my friend Marla Beck, who had founded Blue Mercury. She went on to pivot her model to a bricks and mortar approach as opposed to online commerce, and eventually sold her 60 plus Blue Mercury stores to Macy's for hundreds of millions of dollars. So happy endings all around. I've now been at Hearst Ventures for 25 years.
That's great to hear. As someone who's also probably not going to take the traditional consulting and banking route out of the MBA program, I'm glad to hear that it worked out for you and hopefully eventually for me as well. And it's always funny hearing the sort of path of people into VC because it always feels very, to your point, a roundabout way into it, but everyone has their own roundabout way, which is quite unique, I think, about the industry.
Yep.
Now I kind of want to double click into starting to understand maybe a little bit more sort of the investments that you make. And the first thing is you have made investments in a range of companies in a range of sectors, starting with my old employer Via to companies in the media and technology space. And so I first want to understand, you mentioned Hearst is investing in areas where they have traditional businesses, but what changes in terms of making an investment in a company like Via in the software space to somebody who's more focused on the media and entertainment space? What are some of maybe the challenges and the unique aspects of investing across all those different sectors?
Yes, different industries are different, but I sound like Anna Karenina, but all venture investments same. Every company needs a great founding team. They need an understanding of how much capital they need to get to their next important milestone, which for Hearst Ventures is usually a follow-on fundraising since we invest fairly early stage. I'd say often because what we're looking for are great teams and great founders, some of those questions are transferable across, say, a transportation investment versus a media investment. I'd say what changes, for example, what are the KPIs? Like, how am I supposed to understand if your startup has traction or doesn't? And are you measuring those KPIs? Do I, as an investor, have confidence that you understand what they are, that the other investors around the table understand what they are, and that I do, so that we're all kind of tracking along the same lines? And that's where you can get a mile wide and an inch deep, because an advertising technology KPI is somewhat different than ride sharing software KPI. But if you do it enough times, you start to recognize patterns. If I'm investing in a software business in transportation and it's a SaaS revenue model, some of that may be transferable if I'm looking at a marketing tech SaaS business. Maybe not always, but sometimes it is. One of the interesting things in kind of straddling digital media and software is that I found in some of my companies related to digital media that every investor wants to make it a SaaS opportunity because SaaS is a great model. It's recurring revenue. It's predictive. There are all these KPIs and rules of 40 and things that you're trying to measure the traction of the business with. But when you start to blend a media business model with a SaaS business model, sometimes people try to call advertising revenue recurring, which by definition, it is not. Advertising revenue, you have to go and earn at every cycle. It's not recurring. So there are nuances and complexities to it. I'm not sure that I've answered your question, but I do the best I can to straddle different industries.
No, I think you kind of got at the heart of it. That at the end of the day, there's some sort of fundamentals that apply to every startup, regardless of the industry that they're in. And it's more sort of like the context in which they sit that kind of changes for each sector and investment area is maybe a way to describe it. Obviously, the founder is a huge part of why you invest in all of these businesses, especially in the early stage, right? They are the glue that holds everything together. How did you develop your bar of what a good founder was, especially early in your career, in terms of understanding, does this person really have what it takes to build a great business, or do they not? And now looking back on it, are there sort of any commonalities or similar points that define all great founders together?
Yeah, I think you kind of nailed it there. It's harder to do on your first investment than your 30th investment because you have no pattern recognition. You're not sure what you're looking for. It's as much art as science. You'll feel something in your gut and you have to trust your gut no matter what, because as you know, a venture investment is a long-term commitment and relationship going both ways between the investors and the founding team. You need to be able to look the founder in the eye and look at yourself in the mirror and say, I trust this person. I want to work with this person. I believe that we both have the same intention for this company. A lot has been said about founders, and I agree with many of the things that are said, right? Yes, it is probably the penultimate most important thing in a startup company is that founder and founding team. So you're looking for passion and conviction and maybe some rationale about why they have a lived experience or something that makes them the right person to build this company. You're looking for a little bit of CV, and do they have tools that prove that they have management skills or people skills or a little bit of selling skills, like you're testing their selling skills while they're pitching you the investment, because they're going to have to pitch this investment and sell their product 100 more times after you. And then the one that maybe gets less airtime, but if you're thinking about sideways situations or downturn situations, everything doesn't always go up and to the right. What do you think about this? What is it about this founder that you think she or he might be able to pivot or take a different direction if it's not going just as it was planned at your first meeting and your first investment? Does the person have flexibility? Or is it, this is the mission, so much conviction and passion that they may not be able to ever get off that path? So I said a lot there, but there's a lot to it. And each of those probably are pieces that I picked up in my journey over many years, meeting founders and making decisions about who to back.
Yeah. That's super interesting. And one thing I want to maybe double click on in sort of your response is you talk about lived experience in terms of, does this person, individual, have an experience in the industry or the problem that they're trying to solve? And I think this is often like a hotly debated topic in the venture capital world. You know, is it better to have an outsider who will take a completely different approach and versus somebody who's sort of more used to the way it was done? I think of Daniel at VIA, who came from a neurology background and didn't have a transportation background and ended up building this great business in transportation. So in your mind, what does lived experience mean for a founder, I guess?
Using Daniel as the example, what he did have was a systems background. And he and Oren were unique founders in they were looking to build something revolutionary, not something evolutionary. Like, I invest in amazing ad tech founders who have 20 years experience in advertising technology, and I have tons of conviction and confidence behind them because they know the way that all that piping works, and they know the right people, and they know what matters and where you need to make connections. For Oren and Daniel, because they said, hey, we're going to build a system for mobility that kind of turns mass transit on its head, and we're going to use technology and a systems background to do that. I thought, okay, this is a big deal. This is a swinging for the fences type of opportunity. This isn't an incremental evolutionary investment. That systems background plus their little anecdote about how the Sharut buses worked in Tel Aviv kind of hooked me. And they have proven to be true to their conviction and passion for changing transit as it stands. I have to remind our Hearst executives about that from time to time. They say, Darcy, this was a ride-sharing business. Why is it a software business now?
Yeah, definitely an example of two founders who knew how to pivot, to your earlier point, when things were not going in the greatest direction. So now I want to change gears and talk a little more about like the media and entertainment space. This is a big area of focus for you. And it's a sector that has gone through a lot of upheaval, I think, recently in terms of the way, I was thinking of the media space in terms of the way people consume media today. It's a lot more short form. It's no longer on cable. It's radio, so almost completely died in the traditional way that we know it. And so the job of a VC, I suppose, is somewhat to predict the future. So what do you think are maybe some of the big trends that are going to define the next 5 to 10 years? I feel like the last 5 to 10 years were defined by shift to mobile, shift to streaming platforms, away from cable, away from radio. What do you think are sort of the next trends that are going to be driving the sector and the industry going forward?
Yeah, the 5 to 10 year horizon is really out there. And you can't talk about 10 years from now without talking about artificial intelligence. I think in the nearer term, there are changes within digital media that are kind of ripe for investment. And these are places that I've been spending time. And these are kind of evolutionary types of investments. But one of the headwinds for media has been privacy concerns. If you follow it at all, there are, going back to Netscape, the savvy engineers there invented something called a cookie that would make its mark when you visited a website. And then a number of great early digital media advertising entrepreneurs latched onto that cookie as a means of identification of people moving around the World Wide Web. And they built huge advertising infrastructure on that cookie construct. Well, excuse the pun, but the cookie construct is crumbling and people are running around trying to figure out how to use data in different ways to support the targeting and the measurability and the audience building that the industry for 2 decades had very much become reliant upon to execute successful campaigns and prove return on advertising. So there are opportunities in that category, and that's more in the ad tech programmatic stack. When you think about what Hearst cares about based on where our legacy businesses exist. They exist in print publishing and magazines and newspapers, but also significantly in television. We've got a 20% stake in ESPN, and we own in excess of 30 broadcast television stations. Those are linear businesses. You mentioned the cord cutting, et cetera, and those definitely represent headwinds to those legacy businesses. But what is interesting is the introduction of connected television. And what's neat about connected television is it looks both like our legacy linear businesses in experience. You sit in your living room, it's a big screen, immersive experience, but in its piping and its guts, it's more like digital media because it's connected and you can target and you can measure and you can attribute campaigns, certain outcomes of campaigns back to advertising. That's a category where I do spend time and need to understand that because to the extent that Hearst continues to operate in these legacy areas, one of the charges of Hearst Ventures is to understand the industries and how technology is changing them. And this would be a prime example. So we're looking for opportunities within connected television. Coming full circle back to 5-10-year outlook on AI, I'd say in the nearer term, we can think about things like digital media workflows. How can you make these campaigns more productive? What can you do for someone at an agency to make it possible to actually place a media buy across CTV and the programmatic web, et cetera, et cetera? So what are workflow? How does AI get in there and change those workflows? There are things like bots that people are building bots to make that easier. And then another category, and I'm rambling a little bit now, but I think about all the data that digital media is built on. It was built in a very standards-based way in order to let the programmatic ecosystem work together for the buying and selling to happen at auction in a real-time bidding type environment. And I think now, if you think about 5 and 10 years out, as people start to potentially move away from standards-based systems and just say, hey, there's an LLM for that, there needs to be some sort of semantic data layer where you can take your pockets of consumer data and make it make sense in a way that maybe removes some of the plumbing. And how that happens is well beyond my understanding, but it feels like that's something that might be true 5 or 10 years from now. It's just, do you need a website or do you just need an AI agent that can provide the information needed that tells what your brand is about.
Yeah. That's super fascinating because on one hand, it almost sounds like you're saying like the experience hasn't necessarily changed that much for the person on the back end. Digital media still fundamentally looks very similar to cable media. It just happens that like the plumbing and the business model behind it is a little bit different, but it offers all these different opportunities around potentially, I think to your point around like attribution, is that where you'd say a lot of the value is sort of being created right now? Better being able to understand who your consumer is and maybe attribute a marketing campaign to a specific sale or buy and consumer?
Attribution is important, right? If at the end of the day, the money flows into the system because there's proof of return on ad spend, the attribution is the proof. I'd say you also said something else that's really important. And I'd say there's a huge shift in focus with the exit of the cookie or the slow deprecation of the cookie. What is my consumer? What do I know about my consumer? What relationship do I have with my consumer? What data have they given me permission to access? And how can I use that data to ever strengthen my relationship? We talked a lot about advertising, but there are subscription businesses in media as well. ESPN is one of them, but so is Netflix. You know what I mean? And these are subscription businesses where Netflix has my permission. They have my email address. They have my credit card every month. There's lots of things that create opportunities for the businesses that we consumers have decided to give our permission to.
Sure. The next question that I have, and maybe this is going off tangent a little bit, but when I think about media and advertising specifically in the consumer space, it's hard to not think about Meta and Google and the massive role that they play in sort of directing internet traffic for advertisers effectively, right? And if I think about Google's role in this is right now I go to Google to search a question and then they direct me and I get an ad, so on and so forth. But we were earlier talking about AI. How do you think that will maybe change the way people use the internet? And therefore, if I'm now only going to ChatGPT to get those same answers that I was previously going to, or any one of the big LLMs, how does that maybe sort of change the advertising model?
Yeah, for sure. Well, you already see. Well, so what's interesting is that all the incumbent tech platforms also are the AI platforms. We've got Alphabet, we've got Microsoft, we've got Meta, we've got Amazon and Apple. So ta-da, here we are. They've all got AI and huge advertising models. But to drill in on Google's business in particular, I am sure they are thinking about this. I think lots of people in the industry think that they're already losing search referrals to AI LLMs, to Perplexity and Claude and ChatGPT, et cetera. They're losing referrals there and they're disintermediating themselves. If you type a question into your Google search or your Chrome search bar, it will load up a 10-sentence response that says beta AI, and it has gone out into the internet and given you the answer to your question without ever sending you to the Hearst site that recommended the most fashionable shoes for season or whatever it may be. I think the writing's on the wall a little bit. The search model will most certainly be disrupted, and poor Google, they've got this antitrust case going down both on the search side and on that programmatic open web side, where they represent 30% of that, both in the sell and the buy side in that programmatic traffic. It will be interesting to see, watching Google over the next, 4 quarters. It would be interesting to have this conversation again in 4 quarters and just see what has played out and what hasn't.
I now want to ask, we were talking about this offline before we hit the record button, but the last 5 years have been relatively all over the place, if we can say that, for the venture industry, going from the boom of the zero interest rate period in 2020 to now kind of dealing with the effects of higher interest rates, which has had a large impact on both exits and funding environment for venture capital. So I'm curious at your take on is the fact that it's a lot harder and more expensive to get capital today, and therefore maybe earlier startups are not getting the same capital that they got previously. Is that going to build sort of a better generation of startups in your mind that are maybe a little bit more capital efficient, don't really have the bloat that we saw in some of the 2020, 2021 funding deals? or has it been a little bit of a break on sort of growth and innovation within the industry because people aren't getting the capital that they need?
I hope it's the former. You mentioned the zero interest rates, and I will throw myself under the bus and say in 2017 and 2018, I thought to myself, this market has to correct. The first correction was in 2000 with the internet bubble burst. The next was in 2008 with the Great Recession. In 2018, I was kind of looking around like, okay, it's time for a market correction. These valuations are getting a little high. And then we went to the pandemic and zero interest rate and a number of factors. A lot of capital flooded venture capital. Private equities started reaching down. I'd say the zero interest rate phenomenon, that there was lots of capital looking for any return anywhere, and it turned to venture capital. And what that did for our industry, again, in my opinion, was got things a little bit out of whack with an oversupply of capital. I saw it on the ground, an investor competition that said, I will win this deal at all costs, which usually meant a valuation and a time to close that were higher and shorter than previous market norms, kind of just a free-for-all. Want to call it that. And I think now the market is looking for exits, and it's hard, right? Because the IPO market is maybe a little bit open, but it's not really open. And M&A, you study the M&A multiples and the deal traction, that's down too. I think we're living through a period of correction where for the existing portfolios, you hope to live another day. I've seen lots of round extensions at the same valuation, and we are supporting our companies in that way. I'm seeing some asset sales to, I'll call them opportunistic corporate buyers, which is also what needs to happen in this market. And then I'd say looking at funding for new deals, I'd say that people are more circumspect in 2024 than they were in 2021. The good deals are getting funded without a doubt. And if they truly are an AI that has legs as opposed to something that is an AI and just is calling itself AI, they're getting funded similarly to past eras, but less of that is happening. Venture has pulled back a little bit. Private equity has pulled back a little bit from the venture market, at least. Fewer deals are getting done. And if you're not that A team with the hot idea, it's a hard market out there.
Yeah. Do you think a large part of, especially the M&A market, has been sort of the FTC really, I think, squashing some of the acquisitions recently? I don't want to make this podcast episode political, but it's hard to sort of avoid recording this on the day after the election. Do you think sort of maybe there'll be some positive developments when it comes maybe to like the M&A market in particular? I think the IPO market's a little more independent from the administration, but maybe there.
We can hope. I will say they're the poster children like Figma that didn't get done for FTC purposes. And I don't follow it closely enough to say I have a very strong opinion about this. But certainly if corporate buyers feel like they have a higher chance in a Trump administration than a Harris administration of getting a deal done, then they're probably more likely to kick tires harder and explore those opportunities. It certainly couldn't hurt.
Sure. I now want to change into your experience sitting on boards. I saw that you sit on at least 10 plus boards, if I think I counted correctly. And I'm curious, going back to your experience working in the incubation space and now being a board advisor, what are some of the lessons you've learned in terms of supporting startup founders and startups along their journey? Are there any sort of common pieces that you think you've been really value additive on, or that you sort of have come across as like common challenges with solutions that you think are relevant?
Maybe I'll just turn this in a little bit to an advice giving session for myself. What would I tell my younger self who was sitting on a board for the first time as opposed to now when it's later? I would say you have a good opportunity to create a relationship with the founding team and the company in your seat. As a board, mine are primarily observers, and you should grab that opportunity. In a board meeting, you are an observer, and of course, your opinions matter, but the board is there to get board business done. And of course, you should be careful about taking too much airtime. You want to be value added, not just vamping or saying stuff because the thought flew into your mind. But I would say you do have an opportunity outside the boardroom to say, hey, founding team, whatever it is. I think I have some insights because of the seat I sit in at XYZ Fund or at the Hearst Corporation. And could we do 30 minutes every other month or once a quarter, like in between board meetings, where I just give you some of my observations and I offer myself up to help you get done what you need to get done? Because your board role is really important. As a venture investor, you find deals, you do deals, but then you have to mind them. You have to take care of them for 5 to 7 years or more. Taking advantage and being thoughtful of the things that you can provide back to your founding team are important. I know I probably missed some of what your question.
The second part, I guess, was more about are there common pitfalls that you've noticed that startups on their growth journey fall into that you've often have had a good solution or have been able to sort of have a positive impact through sitting on boards?
One of the things, and it's never popular, but one of the conversations that I've had with more than one of my founders is, are you sure you want to take the highest valuation and not the one that perhaps lines up more accurately with your traction to date? And there are good reasons to take the highest valuation. It's less dilutive. Every single one of your investors, nobody's going to get in the way of you doing an up round multiple valuation because it makes, primarily for institutional funds, it helps them mark up their investment journey. But the piece of advice comes from a place of being concerned about the next round of financing and how do you get that done smoothly and easily and not get out over your skis, be kind of valuing the company beyond where the metrics are. Because even worse than taking a valuation that may be more dilutive than your very highest valuation would be getting to a point where you can't find any funding at all. And guess what you have to do? Wind down the business, cram down the existing investors, like whatever all those bad outcomes are. And sometimes I've found myself able to say that I'm not the lead investor in any round. I can say it as a corporate. At the end of the day, everybody's looking for an exit of the business, and you want to put the company on a path that goes smoothly and without bumps to that exit.
I now want to wind down our episode. We always ask one final question around sort of career advice, given that we are an MBA podcast. So the question I have for you, it doesn't necessarily have to be career advice, but what is the best piece of advice you've ever received? VC, non-VC related, non-career related, personal related, any sort of one-liner around best advice?
Yeah, I'd say it's pretty relevant now and relevant for VC. And I'll tell you why I chose this one, but it's never stop learning. You all are sitting there facing exams. You're like, I don't want to learn anymore. I want to go do. But the fact of the matter is we're entering this AI world. And so I've been listening to a ton of podcasts myself and trying to figure out, what does AI mean? How does it impact the industries that I'm investing in? And how does it impact venture capital generally? And what person after person who builds AI and works with AI says is use it. Just go use it. Learn how to use it, because I've learned a lot of tricks in a 25-year-old Hearst Ventures career about how to do VC and how to value companies and this, that, and the other thing. But the fact of the matter is the bots are going to do it. All my fantastic institutional knowledge is going to be distilled. And my way of being value added will be, how do I use what the AI can do to make me a valuable piece of whatever is going to come, and I don't know what's going to come. But I would say that's my advice. Use it.
No, it's definitely a very topical one, especially being on a college campus. It's definitely a hot button issue of how much should we be using LLMs in class, outside of class.
Yeah.
It's an interesting time.
I don't envy all of you. I mean, in many ways for your youth, for your opportunity, I do. But it's going to be a brave new world that you're headed out into, which is cool. It's exciting.
It's exciting for sure. We're coming up on time, so I just want to thank you so much again for joining the podcast. This was an absolutely great episode. I loved going from talking about founders to trends in media and entertainment. I think we covered a lot of ground.